Yeah, I'm very bearish on Chinese companies. And when you mention delisting, it is true
Yeah.
that the United States is putting some pressure on Chinese companies to improve their disclosure. Now, I would say they never should have received exemptions in the first place. But leaving that aside, we're now at the stage where the US is requiring them to disclose more, higher disclosure standards, more similar to what US companies themselves have to do.
Mm-hmm.
But there's also a move to delist that's not coming from the United States, it's coming from China. The Chinese, remember, they're not driven by the market, they're driven by the Communist Party. And the Communist Party is actually fearful of the power of some of these Chinese oligarchs and Chinese companies. We know all the big names, Tencent, Alibaba, and many others. And so the Chinese are saying, well, you have to delist from New York and list in Hong Kong Stock Exchange, because Hong Kong is now, their independence is gone, their freedom is gone, they're completely under the thumb of the communists. So you're seeing pressure from both sides. The U.S. is sort of pushing them out because they don't meet the disclosure standards, but China's saying you have to get out and come to Hong Kong. So it's all part of the bigger trend, which is the decoupling of the U.S. and Chinese economies. It won't happen overnight. It's a multi-year process, but it is underway. And I would say on the U.S. side, it's driven by national security, and on the Chinese side, it's driven by a desire to maintain a Communist Party control. So, but that aside, even if you took the Chinese companies independently, leaving aside the delisting issue, which we just discussed, the outlook for China is extremely negative. I mean, demographically, they're going to have the greatest demographic calamity or collapse in the history of the world. They're going to lose 600 million people over the next 40 years. And that's their population is aging. The one-child policy has been extremely damaging. 20 million or more girls were killed at birth. And even today, even though they relaxed the one-child policy officially, no one cares. People say, well, we're not getting married. We want education. We want to go to the cities. Marriage rates are down. Birth rates are way down. The replacement rate for any population is 2.1, meaning each couple or each childbearing woman has to have 2.1 children in order to maintain. That's just to maintain the population constant. If you're below 2.1, your population is shrinking. China may be as low as 1. That's catastrophic. That's not a small difference. That's a huge difference. It'll cut the population in half in within 2 generations. So a lot of their technology is stolen, so that's being cut off. They cannot steal as much technology as they used to. The population is aging, and the productivity of older people goes down. Aging is highly correlated with dementia, Parkinson's disease, Alzheimer's disease. A lot of people are going to be devoted to the care of the elderly, which is a worthy thing to do, but it's not. Giving people a bath hasn't changed in 5,000 years. That's not an occupation that lends itself to productivity gains. So, and China has no natural resources, or at least very few. So demographically, industrially, quality point of view, and financially and otherwise, China is going to go into a very steep long-term decline. You should never follow Wall Street recommendations because they actually don't care about you. They only care about themselves. Common sense plays a role. There are independent financial advisors who can help people who are not, in the brokerage industry per se. There are some good economists, not very many necessarily, but there are some good ones. But what I would say is, and I'm more of a macro analyst than a technician, but we have completed what technical analysts know as a head and shoulders formation. So head and shoulders is, the stock market goes up and it goes down a little bit, then it goes up to all-time highs, and then it goes down and it goes up again, but it doesn't get as high as the time before. So it's here, higher, and then back up, but not as high. And then it goes down a lot. If you look at a chart, we've completed the head and shoulders formation. So we're now in a pattern of a downtrend, lower highs and lower lows. That's just the trend. That's how bear markets look. But it's more dangerous than that. It's more vulnerable than that for the reasons we talked about earlier, which are supply chain sourcing, the impact of the war, humanitarian crises, transportation, logistics disruptions, higher interest rates, many other factors. Chinese shutdowns, etc. So I would expect that decline to accelerate. So we're in a downtrend. Nothing goes in a straight line. It doesn't go straight down. There'll be up days and down days, but the trend is downward, which doesn't mean you can't be in stocks, but you just have to be very selective. And above all, I would recommend allocations to other types of assets. I would include cash, land, gold. If you're in the stock market, energy stocks, I think will do well. And really just construct a portfolio with things that are not correlated to each other. I see people, they say, I'm highly diversified. I have 50 stocks in 10 different sectors. And I say to them, you're not diversified. You may have 50 stocks, but you have one asset class called stocks, and they will all go down together. So get some other asset classes, including, as I say, natural resources, gold, cash, land, farmland, and some other sectors. Well, it's always gradual at first and then sudden. So right now we're still in the gradual stage, but watch, I wouldn't expect a sharp downturn until maybe late this year, early next year, meaning late 2022, early 2023, because the Fed is raising rates, but they're kind of doing it slowly. The supply chain is breaking down, but it also doesn't all break down at once. The impact of the sanctions takes a while to kick in. So all the factors that we've discussed will have a very negative impact on stocks, but not right away. It'll be a downtrend, but I would expect perhaps a more severe turn of events in the fall, maybe October.
In conclusion, there have been multiple and overlapping negative factors this year: inflation, rising interest rates, and geopolitical crisis. What advice would you give to investors in the current situation?
Number one advice is diversification, which we just talked about. So have some stocks, have some cash, natural resources, gold, real estate, farmland, maybe some treasury notes, because remember, if the economy really collapses, we could have deflation instead of inflation, and you want to be ready for that. So number one, diversification. Number two, have some liquidity, have a larger than normal allocation to cash, maybe even 30%, because you won't get hurt in a downturn. And when the downturn comes, you'll be able to go out and buy some bargains. Other people will be stuck in losing positions or things they can't get out of, but the person with cash can go around and buy up things at a deep discount. By the way, the number one person in the world who's good at what I just described is Warren Buffett. Warren Buffett has record amounts of cash because he can see this coming also.